Agents Podcast.
I think most people think that when you get a mortgage, it's your mortgage and you have it for the life that you maintain it, whether you refinance, whether you sell and move on. And that option, especially those of us who obtained very low mortgage rates during the pandemic, maybe pre-pandemic, are basically stuck or can't get into those low rates unless, maybe a miracle happens again, right? Because we don't anticipate rates going that low. Well, today, I'm actually very excited to have this conversation. Most of you know me as having a background in mortgage. So this is a conversation that, we have had with many a consumer over the years about assumable loans. And oftentimes it's a big fat no. And by oftentimes, I mean most of the time. So I'm really curious to learn today about how assumable loans are attainable. So we're bringing a guest on, Mike Lorino, with Assume List, who is going to educate us about assumable loans. And Mike, I am first in line here to be excited about asking you these questions, learning about this, because if we as an industry, real estate professionals, can present this as options to our consumers, man, it's going to open up some doors. And I assume you already sharing that excitement. So welcome to the show, my friend.
Hey, Jeff, thanks so much for the introduction. Super excited to be here. This is really what I enjoy doing. I enjoy, I'm a real estate agent. I certainly love working with clients and selling homes, but really my passion within the last 2 months has really been to help agents grow their business and educate them about a very, really powerful niche part of the real estate industry, which is assumable mortgages. I firmly believe that the easiest way right now, as you know, they're in the post-NAR lawsuit settlement era, the easiest way to grow your business is to become an expert in a niche that brings value, that you can bring value for clients in ways that very few other agents can. And I believe one of those ways is becoming an expert in assumable mortgages. And fact of the matter is, there is no shortage of buyers out there who want a interest rate of 2.5 or 2.75%. There's no shortage of those buyers. So the demand is there, right? The demand is there. And the supply in many cases is there, nuanced in different counties around the country, depending on where you are. Some areas, some regions have a greater volume of assumable mortgages than others. But the point is, at the very macro level, there is ample demand for buyers who seek homes with assumable mortgages or seek homes with low interest rates. And at the same time, there's a lot of sellers out there who can't sell or don't want to sell. They don't want to give up their 2.5 or 2.75 or 3% interest rate, right, to take out a new loan at 6 or 6.5 or 7. So you have a lot of sellers who will sell if they can buy with a commensurate interest rate.
Yep.
And then, of course, on the other side of that equation is, well, where is the supply coming from? Well, up until recently, there really hasn't been a mechanism or a way to find these properties. And that's where the platform Assume List came into its own. And that's what we're here to talk about today.
I love it, man. This is going to be good. So let's back it up. You mentioned that you are a real estate agent, which I think is validating and it's important. So tell us about where you come from and what led you to where you are today. How long you've been in the business? Give us the goods.
Yeah, absolutely. Yeah, great question. So, don't necessarily like talking about myself, but I'm happy to answer the question. So I've been in real estate for 15 years. I've been licensed since, 2008, 2009 timeframe, how many years that is. I started when I was active duty. I was a Marine Corps officer for 20 years. I just just retired about 3 years ago. And so for the first 12 years of my career, I was a dual career real estate agent where I was an active duty Marine. And then part-time and on the side on weekends, I was selling real estate. And it got to the point where my business grew so big over the years that I realized, hey, this is something I really want to do after I retire from the Marine Corps. And I ended up retiring at the 20-year mark when, a lot of senior leaders around the Marine Corps kept trying to ask me to stay in command, promotions and all those things. And I said, well, hold on a second. I've got a business, a fledgling business here that I want to nurture and grow. And so I decided to retire to do this real estate full time. And so I pulled my wife out of her government job about 10 years ago as well. And so we do it together as a husband and wife team. We are having this year, 2024, we are having a record year in production. So our point being is we are having the best year of sales this year than we have any year prior in the 15 years that we've been doing real estate. 15 15 years in real estate. I run a small team. I'm based in Northern Virginia, Alexandria, Virginia area. So we're licensed in the whole DC, Maryland, Virginia market. I'm also licensed personally in Florida, and so through Assumable, we also provide services around the country in 18 different states. And yeah, so there you go. So that's my background. Absolutely love real estate. I love training and educating others, particularly agents, about assumable mortgages and about how they can grow their business. Yeah, this is my passion in life, is learning about how I can help people grow their business and become self-sufficient, and really kind of the entrepreneurial mindset, and learning how you can do something different, better than others, and really grow and prosper from it.
So I've got a question that you may not be expecting here, but based on what you just described to me, I think this is relevant to a lot of people, especially in this industry, which is, you know, doing real estate as a part-time or effective potential segue out of another career. You see teachers, you see just people in all kinds of industries. Military, of course, is a big one. And so talk through that a little bit for somebody who's either listening to this, who might maybe be on that fringe, or maybe who's someone who's full into it, but can't break away from a previous career because they're struggling to get any consistency going. Maybe share some of your tips or your strategies and things that helped you get to that point where you could say, I can walk away. Not only can I walk away, but my wife's going to walk away too, which is pretty nuts.
Yeah, great question. So I always go back to this kind of the frame of mind around the idea that for somebody in general, anybody, to pursue real estate, it really, to be successful at it, to do it at a high level, it really does take passion, right? And so when I got my real estate license, I just graduated with an MBA, and I wanted to do something entrepreneurial. I wanted to do something where I had control over my destiny, my outcome. The harder I work, the more money I can make, or the more success I can have, or the bigger I can grow, which is completely the opposite with government work, right? No matter what I do within government work, or certainly in the military, promotions and progression happens at a specific time frame outside of my control. And so that open component of real estate really excited me. What I believe, in order to really be successful, really in anything that you pursue, you really have to have a passion in it. And so, there are a lot of people that are pursuing real estate, and not to denigrate anybody, but just, if the idea is you're going to do it just to make money, it's really difficult. I mean, real estate is very difficult in of itself, and certainly now in the new rule set that we operate under, where you really have to demonstrate value to generate business. Like, you have to truly sell your skill set to clients in order for them to want to work with you. And so I try to make a distinguish between, people who are doing real estate simply because they think it's easy, versus people who are doing real estate because they really are passionate about it. And the people that are passionate about real estate, you can tell very quickly, because they are very eager to learn, they're very eager to grow, they're very eager to understand new ways, new approaches, new methodologies, new systems, new tools. And those are the ones that succeed at it. So whether you're doing it full-time or part-time really doesn't really make much of a difference. Now, for me personally, to answer your question, I started part-time because I was an active duty military person, but I really enjoyed real estate. I thoroughly looked forward to it, to the point at which most of the clients that I worked with while I was still active duty never even knew I was in the military. Just so happens they were only available after hours and on weekends for showings and appointments, because that's when their work schedule allowed them to be available. Just so happens I was only available to work and meet with them after hours and on weekends. So that kind of relationship worked out well. And I can't tell you how many times I've sold homes to clients who really never knew that I was a part-time agent, or never knew that I was even in the military, because when I was with them, it was 100% dedicated and focused to supporting them. And I learned through, a lot of trial and error, but also I found a mentor who helped me through that. So as a part-time agent, you may not necessarily have as much time that you would otherwise if you were doing it full time. And so it's really important to work with, my recommendation would be with a mentor or a team, join a team, or really study. You have to really study yourself and learn what it is that makes you different and unique and special that you can offer to clients with which would make them want to work with you. And so it's not necessarily being part-time or full-time. It's really what can you do and how can you portray yourself in a manner that's going to generate business and allow or have people want to work with you as a result.
How did you generate business when you were working a full-time job?
Yeah, so most of the initial clients, so just case in point, I got my license right around the 2008, 2009 crisis, right? The housing crisis, and you're in the mortgage industry, so you know the whole
Hmm. Oh yeah.
subprime mortgage blowout. So I got licensed right in that time frame. And within the first 30 days of me getting my real estate license, I had 6 listings for sale, all military clients who, like me, we had orders from, we were stationed at Quantico, Virginia, and we had orders to go California, North Carolina, wherever the case was, and we all had to sell our homes. Well, the price of the homes plummeted, and personally, I was again doing research because I was passionate about this, and I learned about this program that was offered through the Army Corps of Engineers called the Homeowners Assistance Program. Maybe you've heard of it, the HAP, and it was a program that was designed to support military families who PCSed or had orders to leave their place of their duty station, and they couldn't sell their home because they were underwater and we couldn't rent it out or whatever the circumstances were. The government stepped in and helped basically cover the difference in the loss in the mortgage so that we didn't have to take a hit on our credit and do a short sale. And so through that kind of learning process, I was one of the first first ones in the country to get that approved.
Mm.
And then I learned how I could help others. And I was like, well, this is my opportunity here. Let me get my real estate license and help my friends do what I just accomplished. And that's how I got into real estate. I actually did it to help others. And I had, through my personal network, through my military colleagues and friends, through my professional career, I leveraged that network to generate my initial, dozen or so clients. And
Nice.
then it just kind of grew from there. And I've just built a reputation through my Marine Corps channels and military channels that I was able to help people with, buying and selling homes. And just so happens that a lot of military families move every 2 or 3 years. So they knew there was somebody they can trust and that I had expertise and I can help them. And that's really how my career took off.
I love it.
Leverage the network that you have.
Were you doing implementing any forms of prospecting or marketing to them, or were you just basically having conversations with colleagues saying, hey, just wanted to let you know I'm doing this now, so if you need anybody? How did you go about that?
It was the latter. I
Yeah.
wasn't, I mean, this was early on in my career, 2009, 2010 timeframe. I was not marketing. I had no online, I wasn't doing any marketing. I had no budget for promoting myself, no Google ads. I mean, there's really nothing at the time. I'm not even sure that like even, realtor.com, those services were just coming online, if I recall. So, I mean, it was Craigslist. People were doing ads in Craigslist at the time, and really it was just for me word of mouth. I leveraged the network that I had access to, and I just let folks know that I'm doing real estate, and I built trust through those conversations. And it wasn't what the volume that I'm doing now, of course, is much greater, but even as a part-time agent where I had a full-time income, if I were selling 1 or 2 homes a month, I thought that was great. And it was literally just word of mouth and just
Hmm.
self-promoting. And of course, once you sell a home to a colleague, they're going to tell their friends. And that's really how I got started is through word of mouth.
That's awesome. And so then fast forward to when you went into real estate all in, which was not that long ago, 2021, I think you said. What was your kind of, where were you at that point volume wise, and what was that tipping point? Was it just something that happened? Was it the volume? Was it the business? What was it that allowed you to do that? That you could maybe give to somebody else to say, this is that point that was for me that you might want to look for when you're looking for that point for yourself.
Yeah, that's a great question. I mean, that's very much a personal question. For me, I knew when I was my last overseas tour, I was stationed in Japan, which is about the time that I had my wife. I had a heart-to-heart conversation with my wife, who was a very highly paid government employee with a six-figure income. And I said, "Hey, sweetheart, how about you quit your guaranteed government six-figure salary with benefits, and quit that and get your real estate license and help me keep the real estate business keep the lights on the real estate business while I go play Marine overseas for the next 3 years." And she did. She did that. And by the second or third year, she more than made up for the salary that she was making working for the government. And then by the time I returned back from that overseas deployment, my wife had a fully fledged business because she was doing it full time. And so I fell in basically on the business that my wife helped grow and develop while I was overseas. And of course, my last duty station, I was at the Pentagon. So I did 4 years at the Pentagon before I retired, while my wife was still doing, real estate full time. And so I was referring a lot of business to her, just because I was working too many hours at the time. But I knew even several years prior to my retirement that was my plan. That my transition plan was to help the business grow, support the growth of the business, and at some point when I was able to retire and be eligible to hit that 20-year mark, that was the game plan. The decision criteria really is, and there's different metrics that you can use. One of them is a financial metric. Are you making enough through real estate where you can give up that full-time salary job that you currently have and be okay? Certainly was easier for me because I'm married and we had my wife's business from her she was producing enough business that we were able for me to retire from government work. Plus, of course, there's a retirement salary there. So everybody's circumstances are a little bit unique. The bottom line, though, is when you are making that decision, really look at it from the standpoint of, are you going to be okay if you make that leap of faith and you jump into real estate full time? And as long as you think that you can grow or you have enough business in the pipeline, and you're on the growth phase, and you're still growing, then it may be the right decision to make that leap of faith and jump over full time.
Yeah.
Again, it's going to be dependent upon everybody's circumstances. I would say right now, I know we're not even talking about assumable mortgages, but I would say right now really is a good time to be in real estate. If you are good at what you do and you are able to bring value to clients, this is, I believe, a good time to enter into real estate because there's a lot more opportunity. The way I see it, whether you're a listing agent or a buyer's agent, there's a lot more opportunity to showcase skill set and demonstrate value when most of the people that are not doing well are leaving the industry, right? There's a lot of individuals right now that are stressed out and are frustrated, and certainly their business isn't growing the way they want it to be. That, to me, I see that as an opportunity when the rest of my colleagues, or when many of my colleagues in the real estate business are looking for the exit. To me, I see that as an opportunity to grow because now there's more market share. Instead of my neighborhood, maybe there's 10 agents competing for business in my neighborhood. Maybe there's only 3 or 4 agents competing for business. And so to me, I see that as an opportunity. And that mindset change, that shifted mindset, is oftentimes all it takes to really put your career, your business on a trajectory, that you've never been able to experience before. Just that small mind shift change. So I'm not afraid of change, right? And that's really what the most successful agents in the industry are not afraid of change.
I love it, man. I love it. And you're right. It wasn't a part of the original conversation plan, but I think it's a very, very relevant one. And maybe more so than ever after coming out of COVID, when a lot of people entered the industry as kind of well, I got some time, I'm working from home, I might as well get my license. And now I think you've seen obviously a lot of them leave the industry. And then there's probably a whole hell of a lot that are contemplating, should I stay? Now, granted, the reality is the person that's probably struggling is not listening to this podcast because they probably don't spend a lot of time enriching themselves. Yeah, exactly. So for the rest of you, there's even more opportunity coming, I think. So let's now take it to where you got, you left the military, you got into real estate full on. At what point in time did you get to this point where you're like, I see something here on the assumable loan side?
Yeah, so great question. And this really, again, leveraging my network, and through that, I mean, obviously being a military veteran and familiarity with VA loans, I knew that VA loans have this feature that enables them to be assumed by a prospective buyer. And so this was about 2.5 years ago when interest rates started spiking. This is basically summer, fall 2022. We saw that interest rates, remember the Fed started raising interest rates, and we saw from the low, the upper twos to then it spiked into the upper threes. And before you know it, in the fall, winter 2022, we started seeing interest rates in excess of 6%, 6.5%. And then, of course, throughout 2020, later 2023 and into 2024, this past year, we saw for the bulk of that time frame, a lot of mortgage rates were in excess of even 7%. So when we saw that start spiking, in that fall 2022 timeframe, I saw an opportunity because I was helping buyers largely. I'm based here in Alexandria, Virginia, so Northern Virginia market. There's a lot of military families, a lot of government employees, a lot of retirees, many of whom have VA benefits. And so I had a client who was military. I think they were active duty, and they were kind of stressed out about higher interest rates. To the point at which I think they had 2 kids and they needed a home with 4 bedrooms. They wanted family to be able to come visit. And I'm like, hey, a 4-bedroom home in Alexandria, at the time, I mean, not much different than today. I mean, you're looking at $850,000-$900,000 for a good size, a decent home. Well, the buying power at a 6.5% interest rate versus a 2.5 or 3% interest rate is substantial.
Yeah.
And so they couldn't afford a $900,000 home for what they were going to buy. Probably they were limited at maybe 650 or 700,000. And that's maybe a townhouse. There's really very few, if any, single family homes, at least in my market, that they could afford that would have met their requirements. And so I said, well, let's take a pause here. What if we, instead of taking out a new loan, why don't I try to help you find a property for sale that has an assumable mortgage where you can buy the home with a 2.5%, 2.75, 3% interest rate and get that full buying power that you initially had, a few months prior. And their eyes lit up and they got so excited, like, well, how do we do that? And I said, well, let me try to find some properties for you that are listed for sale that have an assumable mortgage. And I knew it back in my mind, at a minimum, I'm looking at VA loans. And then through some research, I realized that also includes FHA loans, right? So just for a data point here, government-backed mortgages, generally speaking, are all assumable. So FHA, VA, and USDA, U.S. Department of Agriculture, those 3 loan types are all assumable. But generally speaking, for the most part, in metropolitan areas or urban areas around major metropolitan cities, we're talking about generally VA and FHA. So
I want to just make sure we highlight that for a second. And so and based on your experience, when you say majority, you're saying that pretty much the standard, VA is one thing. Everybody knows VA, military, right? All assumable, which I don't know that, I think, right? Is there any exception to that on VA loans?
Correct. There is a rider that a home buyer signs at the time at the settlement table when they take out a new VA loan that specifically states that this loan is assumable. And it's a VA form that they sign at settlement. 100%, every single VA loan is assumable.
Yep.
And 100%, every single FHA loan is assumable as well.
I don't think a lot of people realize that.
That's correct. Now, what they don't realize, because there's a lot of myths and misinformation and rumors about how the process works, most agents either have tried or know somebody who has tried to do an assumption and it didn't work out. What they don't know, or what they maybe haven't heard, is, well, why didn't it work out? And it didn't work out not because it wasn't assumable. The perception is, well, we couldn't get the lender to approve, and we'll talk about some of those scenarios. But I just wanted to be clear for your audience that 100% of VA and FHA mortgages are assumable. And so we're going to talk about why sometimes they don't get assumed. And so we'll talk about, let me just close the loop on the story. So how this platform became an idea in my head was when I was searching for properties to support that initial buyer back in 2022. And I said, well, let me check the MLS to see if I can search for homes that are listed for sale with an assumable mortgage. And there is no filter. There's no way to search for a property based on the loan type that the current mortgage has, the current seller, homeowner has. That's not a filter. Now, you could, in some cases, look up to see when it was purchased, the last time that home was closed, what type of loan was taken out. In some cases, that's true. You can also certainly pull tax records on a one-off basis and see Sometimes the tax records reflect the mortgage type. But in generally, there's no way to run a search over an entire zip code or a city or location and pull a list of every single assumable home. So I knew that, and I said, okay, well, there's no way to do it within the MLS. What about some commercial solution? And I couldn't find any commercial solution either. And that's really where the idea came about, to develop that platform on my own. And that's really how AssumeList became became a thing. That's how
Well,
we launched it.
so what were you doing? I mean, so what was it that I guess what you figured out is what led to Assume List.
Yep.
And I guess probably you may or may not know this, but I would imagine other agents that have potentially gone down this same path probably just gave up without going any further.
Yeah, I mean, that's the challenge. Is it's not easy without a platform like AssumeList. There's no easy way to find these homes, and really you're looking at on a one-off basis. You can pull a property at a specific address and look at the history and research it on an individual basis to see, well, maybe there's a remark in the comments section by the listing agent, or maybe the tax records state whether it has a VA or FHA, which not all tax records do. Or maybe I can pull the history in the MLS and see the last time this home was purchased. Perhaps the listing agent included the mortgage type that the buyer used when they bought it, right? All of those are variables, and in some cases that information is there, and in some cases it's not. With regard to the remarks section, I hear a lot of agents and even home buyers will tell me, oh, well, I don't need a platform like AssumeList because I can just go to Zillow or Realtor.com or Redfin or one of those search engines, and I can just keyword search for Assumable. And what they don't realize is only about 10 to 15% of all Assumable listings at any given point in time, only 10 to 15%, the listing agent includes those comments. So you're missing 90% of all Assumable homes will never be found by doing a keyword research. Because in fact, roughly half of all listing agents who list a home with a VA or FHA mortgage don't even know that the home that they're listing for sale has an assumable mortgage. I often call up, maybe I'm representing a buyer, and I'll use the AssumeList platform, and I'll see it has a VA loan with a 2.5% interest rate, right? Whatever the circumstances are, and I'll call the listing agent to inquire more about the home, and I'm now informing her that the home has an assumable mortgage,
Wow.
right? And him or her. And most of the time, I'll call initially, and they'll say, "Oh, no, this home is not assumable." I'm like, "Well, I see it has a VA loan. Did they refinance?" And the response will be, no, they didn't refinance. It's still VA. I'm like, okay, so you've answered your own question. It is assumable. And then there's like a 5-second delay. And then I hear, oh, you mean all VA loans are assumable? I'm like, yes. I thought you're the expert. You're the one listing the property for sale, right? So that's the conversation that I often have to educate listing agents about how they work. And we can go through, there's a lot of talking points about timelines and restrictions and VA entitlement. So we can get into that, depending on what level of detail you think the audience might want to know.
Absolutely, man. I think you're the expert here. You've done enough of this. I would like to know, so let's start there. So
Yeah.
Which is kind of a rewind to the ability to get them done. So now you've equipped our listeners to know that, okay, a government-backed loan is going to have the assumable feature, but just because it's assumable doesn't mean that the incoming buyer is going to qualify to assume the loan. So why?
Yeah,
Why
that's great. Let's talk about the requirements, right?
Okay.
So first and foremost, the concept of an assumable loan or assumable mortgage is that the buyer is going to assume the existing loan in its current shape, its current form. You can't modify it in any way, which means that the buyer has to be prepared to take over that loan without being able to add to the down payment or deduct from the down payment. So for example, I'm just going to come up with a random scenario here. You get a home that's listed for sale for $500,000. The loan balance, let's just go with VA. The loan balance on that VA loan is $400,000. That loan has been in place for 5 years. Maybe they took it out 5 years ago. It has a 2.75% interest rate, and it has, let's just say, $2,500 a month mortgage. I'm just coming up with the random numbers.
Mm-hmm.
That buyer, they have to buy that loan. They have to buy that property with the existing loan, meaning they're going to buy the home for $500,000 or whatever they negotiate the sales price to, but they have to assume the loan at $400,000. So right off the bat, that requires a $100,000 down payment. There's no way around that down payment. That has to be provided at the time of closing. We're going to talk through how that works and how there's ways, perhaps some scenarios to help close that gap. But the other benefit though is the interest rate stays the same. We all know that. But also the other kind of fun fact here is that since that loan in this scenario that was already in place for 5 years, that buyer is not buying a home with a 30-year mortgage. They're buying a home with a 25-year remaining mortgage. So the first 5 years of interest payments, which is the majority of interest is paid on the front end of a mortgage, has already been paid for. And the longer a loan has been in place, the more of that interest has been paid, and the less interest that that the current buyer will pay over time. Because remember, at some point it flips over, and the majority of the payment goes towards principal and less towards interest. And so the longer a loan has been in place, the more savings, even beyond just the interest rate, is the more savings a buyer will have because they're taking over the loan in its current form. So in this case, they only have 25 years of payments remaining, not 30. They also get to keep the exact same principal and interest payment. So that low mortgage payment. So really when you shop for, and this is again, just to kind of help agents out there, when you have clients shopping for an assumable property, the interest rate really is not all that relevant. I mean, it's great to know it has a 2.5 or 2.75, but really what's relevant is the mortgage payment. And you really need to calculate what the mortgage or ask what the mortgage payment is on the current loan versus if they were to take out a new mortgage, what that mortgage payment would be. And that savings is really what matters. That's the delta that you're really striving to achieve. And it could be a home with a 3% interest rate has a lower mortgage payment than a home with a 2.5% interest rate. So if you're only looking at interest rate, you're thinking you're getting a better deal. But really what you should be looking at is as the mortgage payment. And Assumist actually has a mortgage payment filter to help clients find the proper mortgage payment. So that's just the basis for how assumable mortgages work. Let's just go into one layer deeper from there, right? So VA loans, so VA and FHA, we're going to primarily talk about VA and FHA. We'll talk FHA first, they're a little bit simpler. All FHA assumptions must be purchased as a primary residence. That means that a buyer who wants to assume an FHA loan must purchase that as an owner-occupied property. An FHA loan cannot be purchased, an FHA assumable mortgage, that home cannot be purchased as a investment property or a rental property. There also is one of the makes it easier to assume an FHA loan is there's no entitlement related question. So if the buyer qualifies, then that will be assumed, that can be assumed. So there's just a financial equation only for an FHA mortgage, where there's when it comes to VA loans, there's this VA entitlement piece that comes into play. Every single VA loan, when the day that the VA mortgage was issued and guaranteed by the Department of Veteran Affairs, the Department of Veteran Affairs mandates that some veterans entitlement or some veterans benefits must be tied to that loan at all times. It's the only way that loan can remain active and valid in place. Now, when you do an assumption, there's a choice. In some cases, a choice. Some cases, there's only way it works. But there's two ways to do a VA assumption. You can either use the buyer's VA entitlement or use the seller's VA entitlement. Remember, some veterans somebody's entitlement has to be tied to the VA loan. So what this means, though, is if a military family wants to assume a VA mortgage and they have their benefits available to them, they can do so, and they can substitute their VA benefits with the sellers, and the sellers would get reconstituted, and that seller can use their VA entitlement for a future purchase. However, a buyer is not required to be a veteran with a VA assumption, and the only way that can be proceeded is that the seller has to leave their entitlement with the home. And there are a number of reasons why sellers would be willing to do that. In my market, we find about literally half of all sellers are willing to leave it for one reason or another. In fact, I've got 4 VA assumptions under contract right now. 2 of them, the seller is leaving their entitlement. 2 of them, the buyers are bringing their own entitlement. So I'm kind of status quo for kind of the statistics there. If you really want to go through some of the details on why sellers would be willing to leave their entitlement, a lot of agents think, oh no, clients would never do that. And the fact of the matter is, yes, they are. And it's just a conversation you need to have with them.
So they're losing their entitlement, which would then mean they're losing their ability to take out another VA loan.
Correct. And it doesn't necessarily mean it's all or none. It's not a binary. Entitlement can be piecemeal depending on the purchase price of the home or the loan balance relative to the maximum loan guarantee for that county in which that loan was first taken out. So if it's in a high cost market like Northern Virginia and somebody buys a $1 million property and they do 100% financing, their entire veterans entitlement is going to be tied up in that property. Conversely speaking, let's just say in that same high cost market, a veteran buys a 1-bedroom condo for $350,000. They may very well be able to leave their veterans benefits with that condo and then move to another state and then but take out another loan, a VA loan on a new home because they have enough remaining entitlement left. So that is possible. But generally speaking, I always like to think of it as being, seller either needs to decide to leave it or decide to take it with them. There's 3 scenarios that are most common that we find where sellers are often willing to leave their veterans benefits. And these are really talking points that listing agents need to have with their clients. And don't just assume, well, they're always going to need it. That's not the case. The one scenario that I can think of, we'll just go through them down the line here. So first case is a seller who is selling with a lot of equity in their property. Because remember, that gap has to be paid for. So maybe they've owned the home, they've got $250,000 or $300,000 of equity, and they're moving from a high cost to a low cost market. Maybe they're moving to Georgia or parts of Colorado or Texas or wherever, and they may have enough cash where they're going to buy their next home cash.
The Midwest.
Or they
How
have
about
enough
that?
available cash where they only need a very small mortgage. Maybe they're going to do 80% down or something like that. And they don't need their veterans benefits. Maybe they're going to buy their home cash and they don't need their VA loan. So that's really not a factor in their consideration for a future purchase.
Yeah.
The other scenario that comes to play often is that you have sellers, a lot of military, particularly VA homeowners, will often have homes they've purchased over the course of their career in different states around the country, and they want to move into, or they plan to move into another property they already own. So therefore, they have no need to take out a mortgage again because the home they're going to move to is a home that they already own. And then the third scenario is, again, depending on it's market specific, but at least in our market, there's a lot of retiring veterans, a lot of retirees, and so they're selling their home. Maybe they're elderly and they're moving in with family, and they have no intent or need to take out another mortgage in their lifetime because they're going to be, they're retiring and they're moving in with their family. So their veterans benefits, their home loan benefit really is not much use of it anymore. So they're more than happy to leave it. Those are the 3 most common ones. When sellers do decide to leave their veterans benefits, it opens up the pool of potential buyers much greater. So it actually benefits the seller to do that because the homes that are advertised as having assumable mortgages will sell for more, sell faster, on the market less time. So and if the seller is willing to leave their benefits with that assumption loan, then there's a greater pool of potential buyers who could assume that mortgage, because now you don't have to be a veteran. A non-veteran who's never served in the military could purchase that property, and assume the loan, who otherwise would not be able to. The other key factor, we talked about this with FHA loans, is with VA assumptions, they can be purchased as an investment property. There is no requirement for them to be a primary resident if and anytime when the seller leaves their entitlement, the home can be used as an investment property from day one. There's no requirement for the buyer to move into it. The only time a VA loan requires it to be owner occupied is during that substitution of entitlement, where the buyer brings their own veterans benefits and substitute theirs with the sellers, because the VA only really wants those benefits to be used for a primary home. Which, of course, when you use your veterans benefits, you have to adhere to that guideline, the VA guideline. However, when a seller leaves their benefit, that guideline does not kick in, and that home can be purchased from day one as a rental property.
So you can be non-VA, non-military,
Correct.
and you could buy it as an investment property.
Correct. And
Nuts,
I have dozens of buyers around the country who contact me who are non-veterans, and they want to invest in real estate. And there's no better way to cash flow real estate than to buy a home with a 2.5% or 2.75% interest rate and rent it out as a much, much greater value proposition than buying a home with a 7.5% investment loan, right? Because you're not going to be able to cash flow it as easily.
Yeah. Wow. That's fascinating. I don't think a lot of people know this. And I think you even said it, you come across sellers all the time and the seller's agent has no idea. I would venture to bet many times the mortgage person doesn't even know
That's
because it's
right.
just not something that's coming across their desk ever.
You most likely will not get knowledge or information about assumption loans from a lender because most lenders don't play in the assumption world.
Yeah.
The only lenders that are involved with assumptions are the mortgage servicers who are servicing those loans.
Yeah.
Um, and of course, so let's talk about that for a second. That's really an important conversation. When a lot of agents out there have heard horror stories. Hey, I heard it takes 6 months to assume a loan, do an assumption purchase. And the fact of the matter is that that was the case about 2 years ago when we first started doing assumptions. That is not the case today. In fact, for the most part, the majority of VA assumptions are now closing in about 45 to 60 days. On average, I'd say about 60 days, but they are trending closer to 45. I just closed one about a week and a half ago, and it took 52 days. I've got another one that I'm getting ready to close. We're going to close that one in 48 days. I've heard some lenders, some of the smaller boutique lenders who are servicing VA loans are closing them in 30 days.
Wow.
And then on the longer end, maybe about 75 days. It really shouldn't take any longer than 75 days to do a VA assumption right now. In fact, the VA came out with a circular in December of 2023 that mandates servicers must approve or make a decision on an assumption within 45 days from the time the loan application has been submitted to the servicer.
So why? But why? Because you would think just on the surface, it's an easier deal because it already exists.
Well, lenders don't actually make money when they do process an assumption. So there's no incentive really for them to do it. They don't want to do them. It's taxing on their staff. They have to go through the full underwriting process. And there's no benefit. Like when you take out a new loan, lenders make money during origination.
Yeah.
Most money on a loan is made, on origination. I guess over the 30-year lifetime, I guess there's interest that accrues. But
For a servicer. Yeah.
in terms of for the servicer, but for the lender, the originator, they make money when they originate the loan. And so when servicers are processing assumptions, there's a very small fee that they're able to charge to help with offset, some of the initial processing and administrative overhead. But there's really no money to be made. So there's no incentive for them to do it on a quick timeline, which is why the VA came out with that mandate that they must be processed within 45 days.
Is it a case of they're effectively trying to find an excuse to say no because they don't really want to do it?
They oftentimes want to say no, but they literally can't. So let's just clarify.
So they delay it. They delay it,
myth.
hoping the buyer will just move on, basically.
That's correct. So the next myth is, can a lender decline a assumption or just tell you at the time that you submit, like, hey, can the lender tell you, sorry, we're busy, we're no longer processing assumptions? And the answer to that question is no. Federal law actually mandates, specifically for VA loans. It's a little more nebulous with FHA, but for VA loans, they're actually required by law to process it. The only scenario in which a VA assumption can be denied is if the buyer doesn't meet the financial guidelines, the underwriting guidelines. But if a request has been submitted, it's an entitlement. It's a government entitlement, just like any other government benefit that a veteran would have. But that, as again, we talked about this in the beginning of the show, is there's a rider that a VA document that all buyers sign when they take out that VA loan that specifically states that the government guarantees that this loan is assumable. And so lenders actually don't have a choice. They're required to process an assumption when an assumption is requested by the veteran, whether that's the buyer or the seller. So the only way that a buyer could be declined or denied that assumption is if they don't meet the underwriting guidelines. So what are those underwriting guidelines? They're actually very lenient. And here's why.
More lenient than just a standard loan?
Yes, and here's why. Whenever an agent helps a buyer put an offer in to assume say VA loan, they're going to have a pre-approval letter from a lender that basically gets your foot in the door so that when you present that offer to that seller, the seller knows you're not wasting their time, right? Just like any other offer for any home, a pre-approval letter is required. The same is true for an assumption. Well, generally speaking, that lender that buyer just worked with to obtain that pre-approval letter, they did their assessment based on current market rates. So let's just say they quoted them, 6.25% interest rate for that, $600,000 property that they want to buy. Well, if they just pre-approved them with 6.25% interest rate, it's going to be significantly easier for that same buyer to qualify for that home at the same price with a 3 or 2.5% interest rate, because the debt to income ratio is much more favorable with that lower interest rate. So the ability to be approved for an assumption loan is easier than it is to get approved for a new mortgage, because a new mortgage is always going to be, at this point day and age, have a higher interest rate, which has less favorable ratios, right? The debt to income ratios are much worse with a higher interest rate.
Yeah.
The second component with it is when you assume a VA or an FHA loan, you are also adhering to the VA underwriting guidelines for approvals. And what's the benefit for both VA and FHA is the debt to income ratios are very favorable. The credit score requirements are very favorable to buyers compared to, say, a new conventional loan. So I've seen VA loans get approved with 55% debt to income, right? Or, 680 credit scores, even lower than that, right? So as long as they meet the standard VA or FHA underwriting guidelines, which are very, very favorable to buyers, they should be able to qualify as well. And that would have already been known at the time the pre-approval letter was granted.
Wow. Fascinating, man.
So I've never seen an assumption not be approved unless really they ran out of time. And really the time frame, the timeline is really the only factor, the only variable. Like the buyer has to move by a certain time, or the seller needs to close by a certain time. And usually when you hear these horror stories about these deals falling apart, it's because one side or the other ran out of time and they needed to move on. But I've never seen a lender I've never seen a lender decline and unless there was something found
Credit
buyer
score,
underwriting process.
DTI, something like
They
that.
bought a car while they were, waiting for their underwriting, and they don't have enough cash, or maybe they spent something and they're late. I actually heard a case where buyers stopped making their rent payments for 2 months before closing on the home, and they basically sabotaged their credit, right? And so those are like self-inflicted gunshot wounds are really the cases where you see where they won't get approved. But short of that, assumptions do get approved 100% of the time.
That's just absolutely nuts. One question about the FHA side of things. You said that the entire, like, they assume everything, which I want to go back and really just quickly highlight the fact that you are acquiring the current term. That is, I can't understate that. Like, that is super valuable because you're right. Like, you just run an amortization schedule, show a client an amortization schedule, and show them the disparity on the interest versus principal in the very beginning. Everybody should know that, but I don't want to assume that. That's huge. Now, when you acquire an FHA loan, I assume you're also acquiring their PMI. You're acquiring all of the things that are attached to that loan.
That's correct. Yeah. So the PMI stays in place with an FHA loan. Now, a lot of people are often said, well, I don't want an FHA loan because the PMI is there and I don't want to pay PMI. Well, yes and no. So with an FHA loan, there's PMI, but for a VA loan, you have to pay it's not called a funding fee, it's called an assumption fee. So there's a fee that's paid to the Department of Veteran Affairs where buyers must pay that at closing as an upfront cost. And that is the way that's calculated is it's a half of a percentage point. So 0.5% of the existing remaining loan balance. And so whatever that loan balance is, there's a half a point paid to the VA to assume that loan. So you're basically front loading, the funding, the guarantee that the VA is going to guarantee in that loan. That doesn't apply with FHA, but you do have the PMI. So, but the thing about FHA mortgages is if you look at that FHA loan, that 2.75% interest rate or 3% or whatever interest rate you're assuming, add in that nominal PMI payment, sometimes, it's $100 a month or, it ranges, but it's a very small number relative to the mortgage payment. Combine those two together and then compare that to a new loan.
To your 6.5% or 7%.
Still be saving $1,000 a month or $1,500 a month or whatever it ends up being. So, who really cares that you're paying an extra $100 a month of PMI? You're saving $1,000 a month or more relative to a new mortgage.
Yeah, don't get caught up in the details. Get caught up in the payment. Period.
Correct. The payment is really what matters most, and that's why I always advise agents and buyers to look at the mortgage payment, not interest rates or other variables, because it's the savings. It's ultimately the net savings per month or over the course of a year that you're benefiting from by doing this assumption.
So I know we're running up against the hour here shortly. I know that you mentioned one thing that we haven't discussed yet, which is bridging the gap potentially on somebody who say, they're buying a $500,000 home is listed for 500,000. The mortgage is 375, let's just say. So they can assume the 375, but the seller wants 500. So you've got to come to the table with 1.25. How do you
That's right.
advise a client on that?
Yeah. So, and that's a problem for many buyers, so a lot of buyers don't have that cash available to close that gap, but they still want to take advantage of the assumption. So there is an option to do a second mortgage on a case by case basis. Generally speaking, the easiest way to do an assumption is to have that cash available. And I always kind of advise folks, like if you can pull cash somewhere, even temporarily, whether it's through an investment account or retirement account, get money gifted from family, because you can do that. That's perfectly fine. I always recommend that to come up with the amount of cash that you need to buy the home, and then at the back end, pull out a HELOC to pull the equity back out of the property. Then you can replenish where you pull those funds from. So if you have the cash and savings, great, not applicable. If you don't have the cash, second step is pull it from a temporary source. You don't really want to, but you can if you need to. And then on the back end, pull equity out of the home through a HELOC, which is generally speaking much more favorable terms than a second mortgage. And then replenish where those funds came from. Return it back to that family member, replenish that retirement
So
account.
a gift is an option.
A gift is an option. Yeah, a gift is an option. You don't have to give it back, but if you wanted to temporarily borrow it, that's an option as well.
Well, I think
for the
sake of being a gift, it has to be something that on paper you're giving back. You're paying.
Correct. That's right. That's right. So the third option, so the first option, cash available. Second option, borrow money temporarily, pull it from someplace you don't necessarily want to, but you can. The third option is taking out a second mortgage. And the second mortgage option, there's a couple ways to do it, but generally speaking, if you already own a home, you can pull equity out of your current home, and then you can use that equity and have the cash for your next home and then sell your first home, right? So there's a couple of different ways to skin that. But let's just say you're renting and you don't have the money available to you and you need to take out a second mortgage. That is possible. There's a couple of factors that come into play. One, not all servicers allow second mortgages. So some servicers will deny an assumption if there's a second mortgage or lien holder that's being introduced to the transaction. I would say about 75% of servicers allow second mortgages, and there's a small percentage out there, maybe 20-30% or so, that don't allow them. And the reason why they wouldn't allow them is because one of the benefits of an assumption is there's no appraisal. So when you buy a home with an assumable mortgage, you don't pay for an appraisal because there's no appraisal. There's no new debt being awarded, no new loan being granted or being issued, so there's no appraisal performed. So because there's no appraisal, the servicer really doesn't have any basis to justify any additional equity in the property that you are now taking out a second mortgage to obtain, right? So they don't recognize that because there hasn't been an appraisal. Now the second lien holder, if you can work with a servicer who does allow second mortgages, and most of the major ones do, Freedom Mortgage, PennyMac, trying to think of some of the other ones.
Like Chase or Bank of
Truist.
America.
I'm not sure about some of those, but for the most part, they generally do allow second mortgages. The other key point of this is the seller also has to be open to that layer of complexity and additional risk, right? Because now you are taking out a second mortgage. There will be an appraisal done with that second lender for the debt that they're going to be awarding. They want to make sure that loan, that second mortgage, there's enough equity in the value of the home is actually sufficient to justify the amount of debt. So they're going to take out an appraisal. So now the total purchase price has an appraisal risk because you have a second loan that requires an appraisal. And so there's some risk there, and sellers sometimes get a little wonky when there's an additional lender that's involved. And so a lot of sellers really shy away from second liens when it comes to assumptions because of the additional complexity. So you may run into that situation. Bottom line, though, is second mortgages are possible. You're likely not going to be able to get a second loan with a traditional lender that you would use. Like Rocket Mortgage doesn't do second loans. Most of your local lenders do not issue second loans. It's going to be mostly banks and specialty, niche lenders who specialize in this. And I work with a few that actually do this. That if anybody's interested, they can contact me. Mike@assumable.com. And I'm happy to help them with that process. But yeah, second mortgages can be done on a case-by-case basis. A little more work involved, but it does help close the gap when it's needed. But ideally it's not preferred for an assumption because of the additional time and complexity that's involved.
So Assume List, tell us about it. Tell us how they can, what it can provide and how they can get access to it, and give us the goods on that.
Yeah, real quick. So Assumist is our basically custom built, patent pending, trademark, pending software that we built from the ground up that will help. It's designed to be a agent tool that helps agents find properties for sale for clients with assumable mortgages. It doesn't require the listing agent to include any comments or check any boxes in the MLS or include any descriptions. If the home has an assumable mortgage, for the most part, will be listed for sale and will be searchable on our platform. You can search based on any standard search criteria, price point, zip code, location, right? However you want to run your searches. You can even draw a custom polygon and draw a custom map and look for properties in that location. You can filter based on VA or FHA. So if you have a buyer that's looking for an investment property, as we discussed, we have to look at VA. You can also set down payment filters. So if you wanted to search for an entire zip code or an entire county and look at every single assumable home all at once, you can find the answer to that in 5 seconds flat, and set a filter. So if you got a buyer who only has 75,000 cash or 100,000 cash available, you can set filters and it will only display homes that meet that criteria, or homes where they have a certain budget in mind, what their mortgage payment they need to be. Additionally, you can run off-market searches. So this is unique to agents. We provide a feature where agents can search for every single off-market property with an assumable mortgage, and every home on our website has an interest rate of under 5%. So just because a home buyer bought a home a year ago and it's got a 6% interest rate that's assumable, nobody cares. Nobody's going to assume that. So sub 5%, I would say about 3/4 of all properties listed will have a 3% or better interest rate. So everything is up below 5% if it's listed for sale. Search off-market properties. You can set your filters. You can even set up automated notifications to clients. So you have a client that you're working with, you can share those properties through the platform, branded to you with your information, your photo, your contact information. It's all branded to you, and you can set up automated notifications. So if you got a client looking for a specific home type in a specific neighborhood, and there's nothing for sale, or maybe you want to notify them whenever any new properties come up, it will automatically send them a branded email with your contact information whenever a new property comes for sale that matches that buyer's specific needs. Those automated notifications are built in. We're not nationwide right now. We operate in 18 states across the country. Most major metropolitan markets where VA loans, I think we cover about 60 to 70% of all VA markets across the country, which includes, Texas, Colorado, California, Florida, much of the Eastern Seaboard, kind of sparse in the Mid-Atlantic or the Midwest region, the Northwest region. We don't cover much of that. There's really few and far between in terms of assumable mortgages. But I would encourage anybody to go to assumus.com/areas served, or you can just go to the homepage and there's a link at the top. And you can see by state where we cover down to the county level to see what we cover. We do have a direct connection to every MLS in which we operate in. So unlike some of the other tools that you may have heard out there, some competitors who don't actually have a direct feed, whenever an MLS feed that is, whenever a property that comes up for sale with an assumable mortgage hits the MLS, we immediately know about it and that becomes searchable. And I think our platform updates on the hour. So on an hourly basis, if a property becomes available or if it goes under contract, it's synced within the hour. And that's kind of the highlights. It has all the photos synced. Everything is available.
Do you have plans of going into all 50 states?
It's very expensive to expand because there's a lot of compliance rules with MLS access, and so we operate as a brokerage, and in each of these markets that we operate in, and so we have to pay subscription fees and MLS licensing fees in every market we operate in. And so some counties and many states, there's virtually no assumable homes. So why would we pay a lot of money for a lot of communities where there's really there's nothing for sale? There's no if it's less than like 1% of homes for sale have an assumable mortgage, there's really nothing available. People just get very disenfranchised, and they often just get turned off by it. So we really focus on those markets where there's a lot of viable homes to choose from.
Got it. And I even see on here, don't see your area, and then you just say join our wait list, so you
Yeah, if
can.
you join a wait list, so if there's a lot of demand in a particular area, like right now we're looking at a couple additional markets we're not in, which is like Charleston, South Carolina. There's a couple other markets in like northern New Jersey. There's a lot of interest there. And so we are looking at that in terms of where there's a lot of demand. And if there's a lot of demand, we will consider that, we'll evaluate it. And that's kind of how we've grown to date so far. Just last month, we launched in North Carolina. So we cover the entire Charlotte, and kind of Greensboro, North Carolina market, and pieces of South Carolina. And then we also just launched in the 4 or 5 major markets in Texas: Houston, San Antonio, Dallas, Corpus Christi, and there's one more I'm missing.
So Houston, San Antonio, Austin.
Austin. There you go. Austin. Yep. So we're in all 5 of those major markets now, which covers, I think, about 70% of all the assumable homes in Texas. We're in much of the kind of central and southern Florida markets. We're not so much in the panhandle yet. We're in, I'd say about 3/5 of the state of California, kind of the
See that?
southern half of California.
Yep.
So yeah, we're constantly growing. It can only grow so fast because we have to get permissions and compliance, and there's a lot of legalities tied to MLS access, as you can imagine. And with these
Yeah.
new rule changes, a lot of restrictions in terms of who can get access and who can and how it all works.
Sure. Yeah. And I imagine a lot of it is tied to military bases as well.
Yeah, we do try to focus. Proximity to military bases is great, although like some markets like Atlanta, where there's a higher concentration of FHA mortgages than there are VA. So the greater Atlanta area, we actually focused on launching there back in late July, because there was just a plethora of FHA mortgages, and so there's a lot of interest in homes in the Atlanta market, and there's fewer VA loans, but yeah, for the most part, we do focus on where major military bases are, because a lot of thousands and thousands of veterans will buy homes there, and they've got a lot, and they move a lot. So there's a lot of inventory available with those low interest rates.
I predict you're going to be going into Washington at some point near the Seattle area, probably.
Yeah, we're looking at
Tacoma.
Seattle. So
Yeah.
funny you should say that, as that MLS is the hardest MLS to get approval for in the country.
Really?
Yeah, they have a lot of compliance rules and restrictions that we are that I have been informed by our MLS our IDX provider. So I'm working on that one. There has been, I would say, ample demand signal from prospective buyers and agents who are
It's
interested.
probably because they allow too many homeless people up there. Maybe that's got something to do with it.
I don't know about that, but
Man, Mike, this has been amazing. Is there anything that I missed that you want to throw in there? I know we've gone past our time, if there is such a thing, but I just want to make sure we got it. I think, I
yeah.
feel like we got it all covered, but is there anything else?
I mean, I think that's it. I mean, really, I would encourage, especially those agents out there, if they really, if you're really looking to grow your business and you want to make it easy, have a conversation with any buyer that you've got on the fence line, or any sellers like, I'm not really sure I want to sell. I don't want to give up my interest rate. Like, join Assume List. I'm assuming if we're in the market in which you service, and then tell those prospective clients, hey, I can help you find a home with a low interest rate mortgage. Would that be of interest to you? And you'll see how quickly those conversations blossom. I can share with you, example after example. I won't do it based on time, of clients who were like, hey, I'm actually, I'm thinking about working with a friend of mine who's an agent. We had a great conversation. I'll say, well, hey, have they ever closed any assumable mortgages? Do they know about assumable mortgages? Do you know that you can buy a home with a 2.75% interest rate? And they're like, no, I didn't know anything about that. Like, so I go through those talking points with them. And at the end of the call, 15-minute phone call, like, Mike, they'll say, Mike, you're the only one I want to work with. The information you just provided to me, you have been the only one who who has ever shared that with me. I want to work with you. You're my guy. Right. And so those conversations that I'm having with prospective clients are immediately translating into signed representation agreements, because I am able to offer them something, or provide expertise that less than 5% of my colleagues, my competitive, agents out there, have that expertise. And so those agents that are interested in growing their business, and like me, for example, my team, we're having the best year in production ever in 15 years of business. Post-pandemic, when everybody was having record months, this year, 2024, is our best year in business because of our ability to market ourselves as assumable mortgage experts.
Yeah, that's amazing. Assumeless.com. Mike, if they want to just directly, you mentioned your email already. You want to say that again? Is there any other way that they can get in touch with you?
Assumable.com is the website. They can submit a help. There's a help form there. They can submit a ticket, reach out to me, or they can just email me at mike@assumlist.com.
I love it, man. This has been very enlightening. Thank you so much for sharing again with the Lab Coat Agents audience. If you missed it on the Facebook page, we're glad that you caught it here, and make sure you get connected. Make sure you go check out assumless.com at the very least and just see if your area is served, and then get to learning, because
There is, last plug, there is a discount for Lab Coat Agent members on the footer of our website, assumless.com. There's a link for Lab Coat Agent partnership, or you can just go to the URL assumless.com/labcoatagents. You'll see Tristan's photo, and there's a form on the right. As soon as you fill out that form, you'll immediately receive an email with a discount code for 15% off access as a agent account, which is our most capable and feature-rich service that we provide. And as an agent, you also have access to me for training and questions about assumptions. I'm here to ensure that the agents that support us and join our network have those resources available to help them grow their business. So yeah, take advantage of that discount code, and thanks very much.
Mike, thank you so much, man. Appreciate you.
Yep.
Lab Coat Agents Podcast.